Welcome back to the channel, lads. Today we are going to look at 3 of the primary principles for managing your personal finances. It's pretty straightforward. We're basically just going to look at your budgeting, debt management, and savings. Now this video is very high level view over these things, so it's not going to get into a lot of the very specific details of them. So we'll be releasing more specific videos that go into a lot more details on each specific things, especially budgeting, because that one's make or break. That can kill your finances if you don't do it right. If you do enjoy the video, please drop a like or subscribe, whatever you want to do. Anything you do with the channel basically helps it out, tells YouTube that, it's a good video, and I'd really appreciate it. So thank you, and let's get into it. Budgeting is definitely going to be the most important thing that we talk about in this video. This is literally going to make or break your finances. Because the other, your debt management and your savings, all that kind of stuff, if you have a good budget, those things are gonna basically fall into line because that's part of your budget. And the very first thing you need to know when you're making your budget is to use your net pay. That's going to be your income after your taxes are taken out. We literally have an entire series coming on how to budget. So for now, just know that your budget needs to include emergency funds, retirement funds, which includes your investments, plus all of your required bills and fixed expenses. So that's going to be your mortgage, gas, electricity, all that kind of stuff. And then you're also going to want to include your optional expenses. That's going to be entertainment, eating out, Netflix, that kind of stuff. All the stuff that you don't absolutely have to have. When you're setting up your emergency fund in your budget, you want to plan for, I like to do at least 6 months minimum. It definitely would not hurt to do more than that, maybe 9 months. And you're definitely going to want to keep that money separate from your normal checking account. Because you don't want to, say you have a big expense, you don't want to accidentally dip into that and not realize that. You want to have that money set aside because that is literally an emergency fund. You also want to set up your retirement funds as early as you can. These kind of accounts really pay much larger dividends the longer you have it. An extra 5-10 years can make a massive difference on the amount of money you get out of that when you pull your money out. There's a freaking 1,000 different ways you can do this. I mean, you can do 401k, 403b if you work for the government or a nonprofit organization. You can do an IRA. I mean, there's literally hundreds, if not thousands, of legitimate ways to save for retirement. There's a lot of people that I find that are just kind of taking a portion of their paycheck, and instead of putting it all into their checking, they'll put a portion of however much they put into a savings account, which I mean, that's good, especially if it's a high yield savings account, but the return on those accounts is negligible compared to any other kind of retirement account. So for me, what I do is, instead of taking a portion of my income and using that to put towards my retirement, what I do is I invest that money into a riskier investment, but also that has a better chance of providing a better return. And then I'll pull a portion of that investment out and I use that to invest into my retirement account, like a Roth IRA. I tend to stick away from the traditional accounts, even though they do have some benefits. I like having everything pre-tax. That way I'm not paying tax on the earnings that I make in those accounts. If you still have a pretty long time before you plan on retiring, I would suggest that most people do it this way because, I mean, it's definitely more risky, but you have so much more chance to make more money because those high risk accounts have a way better chance of earning a greater income. And if you diversify that portfolio and then pull some of that money out and put it into a relatively safe retirement account, maybe a IRA or something like that, you're going to end up with 2 different rates of growth. You'll still have the official retirement account if your high risk investments fall through, and you'll have the years to deal if something happens. But the chances of that happening are marginally low. Oh, I should also say you need to review your budget often. Legit, you need to look at it at least every 6 months. Even that is that's too long. You need to be reviewing it more often than that. I look at mine monthly. It's on my calendar. It's just one of the things I do every month. At a minimum, I would say you should aim for once a quarter. I get that some people are busy. It's maybe not a huge priority for everyone, but that's how you keep a roof over your head. It's important. It's how you feed your family. It's how you go to the movie theater. So yeah, review it at least once every 6 months. If you're lazy, aim for once a quarter. If you're average, if you actually want to stay on top of your finances, just look at it every month. It doesn't take that long. It's fairly straightforward, especially with the platforms we have out there now. There's a lot of different platforms out there that you can attach your bank account info to, and it'll automatically categorize everything, and essentially it makes the first half of the budget for you. It's super simple nowadays. We got technology and stuff. And if you know that you have a big expense coming up, like maybe you're gonna buy a new car or purchase a home, something like that, you want to try and account for that in your budget. Even if it's a temporary modification of your current budget, you can. So like this is what I do. I have my standard budget, and then if let's say when I bought my car, that was I think 5 months ago, something like that. Yeah, 5 months ago. I created a separate budget that was essentially just planning how I'm gonna set up savings for putting the down payment on that car and how I'm gonna finance it in the future. And then once that purchase is completed, I just revert back to my standard budget. When you're doing this, though, you want to be using something called Smarter Goals, which you've probably heard of them. They're very popular, which is essentially just goals that you can define certain criteria for. So they're specific, measurable, achievable, relevant, time-bound, and then evaluated and revised. So the first part the first part is specific. That is the who, what, where. That's all that crap. This is literally all you do is define what the goal is. It's nothing more than that. Measurable is, it's not what it actually sounds like. So it's not measuring like your progress on the goal. It's defining what you're going to measure. Like, let's say you're going to measure how long it takes you to do a certain task in that goal, or to save a certain amount of money, whatever it is. It's just defining what you're measuring. So let's say that you're saving for a purchase and you want to review how much money you've saved towards that goal over a specific period of time. That's what you're determining when you define the measurement. You're determining what you're measuring and against what. So in this case, it would be the amount of money saved versus the amount of time spent saving that money. Achievable is literally the most obvious thing in the world. Essentially, just don't be an idiot. I mean, that sounds a little bad, but I mean, that's the truth of it. Your goal needs to be realistic. It needs to be achievable. That's why it's called achievable. So, I mean, if you're trying to buy a $40,000 car in the next year and you're saving, let's say, $100 a month, you're not buying that car. You got not even close to enough money to make that purchase. You need to actually plan things out and find out what your limits are, what you can actually do. And by the way, that's a really good way to find out where you're making extra expenses that you straight up don't need. That actually brings us to if the goal is relevant. And this is basically looking at if the goal is reasonable, as in if the goal itself, not in relation to you, just in general, is worth the effort that you're gonna be putting in to achieve that goal. And the second part of this is looking at if it's good for you. It's the same thing, but it's specific to you, if it's worth your effort. It means you need to look at things like what your individual resources and abilities are. I mean, if you're trying to make a really big purchase, but you can't save very much money, quickly at least, then it might not be relevant to you, and you need to readjust your goal here to give it a longer time frame for you to be able to save up that money to make that. Let's say it's a house purchase or something like that. It's got to be a logical or a valuable goal, and it's also got to work for you. All right, so time bound is the last, call it, component of the traditional SMART goal. And this is literally, you're just setting the time frame that you expect this goal to take before you achieve it. So maybe you want the goal to, say, be accomplished over a certain number of years or months, whatever it is. Literally makes no difference. It's just whatever works for that individual goal in relation to you. And it basically just provides a means of measuring yourself against your goal. It also keeps us from people like they'll want to do something, but then anytime like they have a chance to do it, they're like, oh no, I'll do it later, or no, now it's not a good time. This stops all that because the deadline's not changing. So as that deadline comes up, you're able to compare the amount of progress that you're actually making versus what you expected to make. This is a super good way to find out if basically you're messing up. Because I mean, if you're planning your budget properly, then all of the money towards literally all of your goals is going to be set aside and accounted for. So if you're not meeting your goals, that means you're messing up in your finances somewhere. And you should, if you're doing your budget properly, you should be able to check that and see where you're slipping up. Maybe you're going out to eat too much or whatever it is. This is an excellent way to find out where you're spending extra money that you're not accounting for. And the last two components of a smarter goal is evaluation and revision. Evaluation is, I mean, we talked about this earlier in the video. It's literally just looking at your budget. You should be doing it once every month. If not that, then at least every quarter. If not that, then you're failing. My bad. But yeah, this is literally, you just look at your budget and basically see how well you are keeping on track with what you've set up for your budget. If you're meeting your goals, if you're paying off your credit cards at the amount that you want each month or each year, whatever it is. This is absolutely specific to you. But if you don't take this step, then, I mean, honestly, creating a budget is just a waste of time. It's not going to help you to make a budget if you never look at it. You have to be able to create the budget and then continue to evaluate yourself and see how you're keeping up with your budget and keep your optional costs down while successfully paying for things like your fixed expenses, as well as putting money into like retirement and all that kind of stuff. Revision it's honestly just the second half of the evaluation of your budget. After you've looked at your budget and you found any areas where you're either excelling or maybe you're falling off the wagon a little bit, this is the time where you want to make the changes either to your budget or to your habits to align yourself so that your budget and what you're actually doing match each other. And the goal here is to do that so that those two things fits within your goals, so that all three of those are working together and you're actually making some progress towards some healthy personal finances. There are two things that I want to mention when it comes to the revision of your budget, and these are both for cutting out unneeded expenses. So an overgeneralization of this is that you have expenses that can be cheaper and expenses that you straight up don't need to be spending. And I mean, there is some interchangeability, I guess you'd say, between these two categories, because let's say Netflix, you could argue that that is an expense that you don't need, but maybe that is your only form of movie entertainment and you're just not willing to get rid of that expense. That's totally fine, but maybe there is a cheaper option you can use for a Netflix subscription, and that would put that expense into the category of having a cheaper option versus a straight up unneeded expense. So this is something that's personalized to you. I mean, honestly, what category it's in doesn't make much of a difference as long as you're acknowledging that it is a cost that has the potential of being lowered, so there's more money staying in your bank at the end of the month. So as far as cheaper options go, it's literally anything that has a cheaper version or an alternative, whether it's through the same company or a different company, that allows you to pay less money for the same or similar services without, giving up the ones that are crucial to you. So let's say you have Netflix, but you also have HBO and Amazon Prime movies and whatever else there is. I'm sure there are Disney Plus. Like, you absolutely do not need all of those. Pick one and save the rest of the money. You don't need to be spending all that, unless you're spending like 18 hours a day watching every movie ever made. You were throwing money out the window. I mean, the goal here is literally just finding expenses that you can cut out completely. Maybe HBO out of Disney Plus and Netflix and HBO, you cut out HBO. That's totally fine. Maybe you can cut out all three. You can buy a 100% legit Fire Stick and then just cut all those expenses, and you only have to make a one-time purchase of the Fire Stick, which I don't know how much it costs, but it's cheap. It's not expensive. It would take, even if you had just Netflix, I think it would only take a few months, less than a year for sure, to offset the cost of the Fire Stick. So, I think that's a pretty easy choice to make. You just have to know that option is there for you and actually take the action to do it. Okay, so outside of your budget, there's a few more tips that I would really like to get, because this stuff is so important. I can't stress that enough. I don't know, when I was younger, I didn't know nothing about money. I was spending on freaking nothing good. I think I was probably early 20s before I spent my first dollar on anything worthwhile for actually being beneficial towards myself, my financial future. And I didn't have any credit till I think very early 20s. I got my first credit card, which is something that you need to start as soon as possible. It is so important that you get started on building your credit history and educating yourself on credit, because it's not complicated, but it's definitely not straightforward, and there's a lot of stuff that you probably will just never find out about unless you do the research. Like, let's say you missed a payment. There's multiple options on getting that stuff taken off your credit report, and that's 35% of your credit score. Just that one thing, your payment history. I mean, we're gonna have a full series with every video under the sun on this, because credit is just that important. It's gonna make a huge difference in your life. Like my first car loan, I want to say it was like 24 point something percent. That was before I had any credit at all, no credit card. Literally no credit history whatsoever. And that car loan was almost the legal federal limit of what they can charge me on interest. Now, my current car loan, which I got about 5 months ago, that's less than 1%. I mean, that's a huge difference. So yeah, you just want to make sure you're always practicing healthy credit. You know how to do things like compare and understand what your interest rate actually is. Because let's say like your interest rate and your APR, that's not the same thing. Those are two very different things. Well, very different might be stretching it a bit, but they are different things. They're used in different calculations. And even with that, like you could say that the interest rate is the amount of money that's charged in addition to your principal on the account. But even with that, you can't use that as the basis of doing any calculations because it's not enough information. Because there's multiple types of interest, like a mortgage and a revolving credit account, like a credit card. Those are almost always going to be different types of interest. Mortgage, that's going to be a simple interest account, but basically all of your revolving accounts, your credit cards, those are compounding interest. And even with those, sometimes the compounding rate is not the same. So like one account might be compounded continually, another one might be compounded monthly, daily, whatever it is. There's a lot of different things you got to look at if you are really trying to maximize your credit and the amount of money you're making. Well, not making, but saving. That's some of the stuff that you need to look at when you're comparing or essentially shopping for a credit account. You should also look at things like the term length, or if there's any origination or recurring fees, like the annual fee you'll see on a lot of credit cards. That's all stuff you need to look at, because even if, like, let's say you have a card that has a better cashback rating or something like that, maybe gives you 2% versus 1% on something, but it has annual fee of $200 and you're making only the occasional small purchase on that card, that annual fee is gonna absolutely offset any savings you make with that 2% cashback versus 1% with a cheaper card. Also, absolutely always keep in mind that credit is not cash. If you treat it like cash, you are absolutely gonna get screwed in the end. You are gonna have so much debt. You cannot treat it like cash, because it's literally not your money. It's money you don't have. If you use credit to make a purchase that you otherwise couldn't afford, you're not only paying extra money on top of that, but you're almost guaranteed to be giving up part of your savings or income that you would otherwise use on something else to make those payments to pay off that freaking card that you shouldn't have spent any money on. And also, if you haven't started investing yet, you want to keep in mind the rule of 72. This is specific to the compound interest accounts, and essentially this is just something that you use to calculate how long it's going to take a compound interest account to double in value. I should actually mention, this is not for variable rate investments. This is specifically for fixed rate investments that you make. If you use this calculation, it won't put out the right number for a variable rate investment. I'm working on a whole video literally just on how to use the rule of 72 to do calculations on your investments. So don't really worry about it too much right now. I just wanted to mention it so you have an idea of where to get started with planning some long-term investments. Oh, by the way, if there's anything you guys want to know, like something you want me to explain, or just even a different topic that you want me to cover, just let me know in the comment section down below. I'll be more than happy to talk about whatever you guys have questions about. I mean, that's what this channel is here for. Yeah, I mean, just let me know. Also, if you enjoy the videos, let me know too. I'd be really happy to hear some of that. That would definitely make me feel good. So yeah. So it's also probably good for you to understand the difference between a good and a bad credit account. And while this can technically be a little confusing, or I guess indeterminate would be a better way to phrase that, it's pretty straightforward to figure out. It's literally, if an investment has the potential to increase your net worth, it's a good credit. If it does not have that, it's trash, worthless, bad credit, evil. So if you finance a computer online, that is not good credit. That is, I mean, like, you might as well finance a freaking toy. Like, it's not good for your credit history. If you buy a house, that will be good credit because, I mean, it's going to appreciate in value over time, but it should unless some weird shit happens. And I mean, I'm sure you've guessed, but you probably want to avoid bad credit accounts because they're bad and not good. You know, logic. Yeah. Also, you might want to consider getting insured, especially if you're like not crazy young. I know I got a baby face, but I'm not that young, so like I got some of that good old insurance, and I mean it basically just protects me and even my family if things go really bad. Yeah, if you have some crazy expenses like hospital bills or whatever, it's just gonna have your back. I think it's better to spend some money now than spend all of your money later. I mean, I think that's a easy choice to make. So, you know, when it comes to managing your debt, there is 4 different ways to do this. Well, there's really 3 different ways to do this, and then a few debt relief methods that are available to you. One that's probably better than the others when things are not way down the rabbit hole and you're in way over your head. I already have a whole video on actually both of these topics prepped, so, you know, check for those, you know, subscribe. But my personal suggestion is to always prioritize your highest interest rate accounts first and essentially just work your way down. This is kind of harder to manage for a lot of people, especially if you easily get demotivated or forget about it, or you know, whatever. That's totally normal. That's probably what the vast majority of people are like. I mean, I was like that for a really long time, and it took an absurd amount of practice to kind of break through that habit. So yeah, I would just suggest that you pay off your high interest account first, and then you basically snowball that down into your smaller interest rate accounts, and that'll just, you know, it'll save you a little bit of money in the long run. There is another method where you tackle the smallest principal account first, and then you snowball upwards until you get to your biggest account. That method is really good for people that are they easily get demotivated or they stop making those payments for whatever reason easily. Because it's a good feeling when you close a debt account, and it just helps people stay motivated on track so that they continue to make progress where they may not have otherwise. Alright lads, that is the end of this video. Thank you all so much for watching. I truly hope it helps you, and thank you so much. If you do enjoy the video, please consider liking, subscribing. I mean, honestly, any kind of interaction with the video helps tell YouTube that it's a quality video, and they'll help promote it to new people that might also find it useful, and, you know, maybe we can help some people out.